The tax filing deadline in April may be circled on more calendars and strike more fear into people than December 31st, but the year-end cutoff for certain tax planning items deserves your attention. Once the clock strikes proverbial midnight with your custodian, year-end cutoffs can turn your good financial intentions into a pumpkin. And that's why I'm going to remind you of 7 tax planning considerations before the year is up. Hey everybody, I'm Curtis Crossland of Suttle, Crossland Wealth Advisors. I help folks build more tax efficient and focused retirements. Let's just get straight into this. Not to overstate the obvious, but once certain deadlines have passed for financial action, you run the risk of missing valuable opportunities for that tax year. And in some cases for folks in RMD years, mental lapses on miscalculating RMDs or forgetting to take them can come with some pretty painful penalties. Custodians may also have cutoff dates that supersede the end of the year. You'll want to pay attention to specific dates. One of the first things investors tend to consider as the year comes to an end is if they have any tax loss harvest opportunities. Now, this may be something that you're already doing throughout the year, but taking some time at the end to give everything a once over may provide last-minute opportunities to either reduce gain or find some carry forward. Harvested losses become a tax asset and can be a valuable resource to investment decisions in future years. The second thing investors should be reminded of, and closely related to tax loss harvest, is the management of investment income. Perhaps you're in a year with higher than expected income or about to go into one. The end of the year can be a time of clarity for folks when it comes to the income for that year, and may be an opportune time to look at things like reallocation, rebalance, or even strategic use of pre-tax accounts. This can also be an important time for anyone considering Roth conversions. The Tax Cuts and Jobs Act in 2018 has eliminated recharacterizations of Roth conversions. Folks need to take great care in what they end up converting as it's now permanent. Another critically important item for several folks is going to be required minimum distributions. Deadlines for RMDs are extremely important. The penalty for late distribution or failing to distribute can be 50% of the required amount. In addition to timely distribution, RMDs are also going to require calculation. And don't forget, RMDs are often a boost in income, which can mean more taxes. And now all of a sudden, you may be far more interested in the first 2 items discussed as it relates to tax loss harvest or managing investment income. And you really don't want to wait till the last minute. Deadlines are also in place for gifting, and this includes gifting to charity. Whether you're philanthropic for personal or financial reasons, for a gift to count for tax purposes, it has to be made within the calendar year. Timing may also be important if you're trying to gift stack for itemization opportunities or for making qualified charitable distributions. QCDs can be a useful tool to those that qualify and are looking for other ways to help reduce their RMD requirement. But processing isn't always instant, and custodians can have differing deadlines than the end of the year. Also on the topic of gifts are gifts to individuals, i.e. your family or really anyone. The annual gift exclusion amount for 2023 is $17,000 per donee, and married couples can actually double up on that. This is often a go-to for those that are looking for ways to reduce their estate, or for those that are just incredibly generous and want to help out friends and family and experience the joy of that gift during their lifetime. I know not everyone is in a position to gift like this, but hey, you never know. Kissing up to the right people may end up working out for you. Flex spending accounts are also something that you don't want to forget about. These can be valuable accounts to those that are still working, contributing, and have ongoing medical needs. There's been a couple updates over the years to things like a grace period or a little bit of carryover, but you don't want to end up forfeiting any of your FSA dollars simply because you forgot or ran out of things to spend on. There's an extensive list of approved uses by the IRS. I've linked it for any last-minute FSA needs. The last thing I'll remind you of is any contributions to retirement accounts. Now, you do have longer deadlines on things like individual retirement accounts going all the way out to the tax filing deadline in April. This may seem like a too little, too late reminder, but if you're in a position to be awarded a year-end bonus, that may be an opportunity to catch up on any missed contributions. If you don't use it, you lose it, and that's the theme for these reminders. No one can give you back time, and once the door closes on a financial opportunity in a calendar year, it's closed forever. I'd encourage anyone to learn more about financial planning topics, especially those that are tax planning specific. That way you can be better prepared to take advantage of things like your time value, tax efficiencies you may have missed, and really just work to reduce your lifetime tax drag. Once more, I'm Curtis Crossland, and if you want to see how we help folks build a more tax-focused and tax-efficient retirement, be sure to check us out at www.suttlecrossland.com and subscribe for future videos.